Hello everybody, good evening. Please confirm, is my audio video clear? Is my screen properly visible? Okay, super, super. Everybody all set? Okay. Please give me a quick thumbs up. Thumbs up is to tell me everybody is all set. We are good to go. And hand raise is to ask question. All right, all right. So welcome. This is our session number 1. My name is Swati Gupta and I'm a chartered accountant. You already know me. I have 5+ years of experience in IFRS and I'm here to simplify it again for you. All right. So we will be reading IFRS in detail. Before starting, I'll tell you why IFRS, why are we learning, what is the story behind it, how it is connected to Ind AS, what will be our paper pattern, and then we'll head towards the topic. All right. Okay, I'll give you an interesting story. Have you heard about Enron company scandal? Tell me yes or no. Have you heard about Enron company scandal? Okay, no. Okay, I'll tell you about it. Enron company was a US based company. Okay, it was a US company and it used to manufacture and deal into oil and natural gas. Okay, it had multiple mergers, acquisitions, and all. And thereby, do you agree when there is a merger? Let's say Honda acquired Hero Honda. All right, we have Geo acquired Hotstar. All right, example Vodafone and Idea. Do you know about these mergers? Tell me yes or no. Correct. Okay, nice. Okay, so similarly, when there is a merger like this, when they so the board of directors increase. The board of directors might come along. That there are two companies and all the board of directors are coming along. So similarly here also when merger happened, then Jeff Skilling, one of the most I would say crucial member, came on board with the on the board of directors. Okay. Now, when Jeff Skilling came on board, Jeff Skilling, he proposed that all the business which are profitable, let's include them, and all the businesses which are not profitable, which are loss making, let's not show them. All the loss making business should not be shown. In the loss making business, they tried to hide debt. Okay, all their losses, unpaid debts were hidden into the companies, whereas they tried to inflate revenue. Now, do you agree if any company shows only profitable businesses, hides losses, okay, hides debt, inflates revenue unnecessarily due to fair valuation and all, do you agree the financials will appear to be super profitable? Correct? Give me a quick thumbs up. Correct? That the financials will look so profitable. If an investor looks at the financials, it is very sure that they will get highly impressed that, okay, wow, such a good company, such profitable company, we can go ahead with more and more investments. Now, what happened in 2001? In 2001, there was a twist. Enron company went into bankruptcy. Enron company went into bankruptcy. It raised a question on entire financial reporting. This entire scandal, this is known as Enron company scandal. This scandal raised a question, a huge question on financial reporting. It raised a very huge question on the accountant and on the financial reporting, that why the figures are not representing the actual situation. Why there is so much gap between the numbers and the actual situation? Why the financials are showing so much profits, but the actual situation is of bankruptcy? Why the financials are not reflecting the right figures, right situation? It raised a huge question on financial reporting. Okay, do you guys know Big Fours, Deloitte, PwC, EY, KPMG? Tell me yes or no. Have you heard about it? Do you know Big Fours? All right. Okay, everybody does, correct? Earlier, Arthur Anderson was audit firm for Enron company. Okay, for Enron company, Arthur Anderson was the audit firm. It was one of the big fours earlier. It was one of the big fours earlier. Big four consultancy firms earlier. Okay, but because of this scandal, it got dissolved. Okay, dissolved in 2002. Do you agree? If the company goes down, they take their auditors also down. Correct? Okay, all right. So this is a story, Enron scandal. Enron scandal came into picture, and thereby the audit firm also had to dissolve. It also had to dissolve. Now, in order to improvise this financial reporting, okay, IASB, International Accounting Standard Board, came upfront and said that, okay, do not worry, I step in, I fill in the position, and I will improvise the entire financial reporting. I will make it better. The disclosures will be more clear, more better. The presentation will be improvised. All right. So we have IAS. IAS stands for International Accounting Standard. IAS stands for International Accounting Standard. This is given by IAS committee. Okay. Earlier we had 41 IAS. All right. Now, in order to improvise, IASB came into picture. IAS board, International Accounting Standard Board, came into picture. Okay, was formed in 2003 and said that do not worry, to improvise, we will introduce a separate line of standard which is known as IFRS. IFRS stands for International Financial Reporting Standard. Okay. IFRS stands for International Financial Reporting Standard. Now, wherever minor changes were required, or in order to improvise, major changes required. There can be two cases. In some standards, there were minor changes required. In some standards, major changes were required. All right. So wherever minor changes were required, they continued with same standard and added amendments. All right. Whereas where major changes were required, altogether the IFRS needed to, the standard needed to be, I would say, restructured. It was not giving the right presentation and disclosure guidelines. Thereby, what they did, they abolished the existing standard and instead of this, replaced it by a new IFR. Okay, give me a quick thumbs up. Do you get this story? That earlier there was an Enron scandal, and thereby they had to improvise. For improvising, IASB, International Accounting Standard Board, came upfront and said that do not worry, I'll fill in this, I'll improvise. I take the responsibility of improvising. Wherever minor changes were required, the standard continued and amendments were added to it. Whereas wherever major changes were there, they abolished the existing standard and instead of this, replaced it by a new list of standard known as IFRS. All right. So currently we have 18 IFRS. This means 41 minus 18 equals to 23 and plus 19th IFRS 19 have been recently introduced. IFRS 18 and IFRS 19. Okay. So all together, if we talk about this, in foreign countries, we have total 42 standards. All right. Out of this, we have IAS. There are 24 IAS and we have IFRS. There are 18 IFRS. Together, this IAS and IFRS are known as IFRS standards. Okay, therefore you would come across there are sometimes IAS, there are sometimes IFRS, there are so many different numberings. Okay, so together they are known as IFRS standards. Okay, we are good till here. Now, have you heard about Ind AS? Tell me yes or no. Is my audibility clear? Everybody all set? Any glitch? Okay. Have you heard about Ind AS, Indian Accounting Standard? Yes. Okay. Hafiz also. All right. Ravindra Jani. Correct. Okay. Now, if you learn IFRS, I promise that you will learn Ind AS alongside. You don't need to learn Ind AS separately. All right. I'll try to pick up some very simple examples so that the entire concepts become easier. All right. And then we'll go ahead with some journal entry in order to see how does it impact your financials. Before going ahead, what is Ind AS? How it is connected with Ind AS? Ind AS, Indian Accounting Standard. Indian Accounting Standard, it is known as Ind AS. IAS and Ind AS are different. IAS stands for International Accounting Standard, whereas Ind AS stands for Indian Accounting Standard. What is Ind AS? Ind AS is converged form of IFRS. Okay. Ind AS is the converged form of IFRS. This means in 2014, do you agree Modi ji came into power? In 2014, do you agree Modi ji came into power? Okay, good, nice. Okay, now Modi ji tried to bring many changes, all right? And thereby they said that it is high time we also need to apply and accept global standards. So therefore, IFRS were being adopted, copy-pasted, accepted. But India has not accepted it 100% as it is, but instead of this, they have accepted it with some minor changes. Why those minor changes are there? Because do you agree that every country has their own, I would say, methodology, social norms, okay? People differ, their mental, I would say, understanding differs, correct? Technology level differs, understanding level differs, all right? So in order to make it smoothly applicable in India, they had to make some changes. They had to provide some flexibility, some options, so that in India, they face very minimum resistance to change. All right. Converged means accepted, adopted, copy pasted, but with some changes. Converged means accepted, but with some changes. They've accepted it, but with some changes. Now, what are these changes? These changes are known as curves. These changes, these differences are known as curves. Have you heard about curves? You can unmute and speak up also. That is also all right. If you have any question, then also you can go ahead. You can write in the chat box. Be comfortable. Okay, nice. Good. What is carve in and carve out? Carve in and carve out. Anything that is not present in IFRS. What is carves? Carves are the changes between Ind AS and IFRS. IFRS and Ind AS are, I would say, 95% same. Indian accounting standard is nothing but a replica of IFRS. Alright, a copy paste of IFRS. Why? Because India also wanted to apply global standards, accept global standards. Alright, Pavan, alright. India wanted to apply global standards and thereby India has accepted IFRS. Now, some changes are there. They have made, let's say they have added one provision, extra flexibility, extra option. So those changes are known as carves. What is carves? Carves are the difference between IFRS and Ind AS. Give me a quick thumbs up. Pavan, all right? Clear? Okay, nice. Now there can be carve in or carve out. If something is not present in IFRS but have been added in Ind AS, okay, added in Ind AS, added in Ind AS, which was not present in IFRS. It has been added in Ind AS, but this was not present in IFRS. This is known as carve in. Something have been removed from Ind AS, which was present in IFRS. All right, which was present in IFRS, but it has been removed while preparing Ind AS. That is known as carve out. If you remove something, if you eliminate something while preparing Ind AS, any provision, any guideline that has been eliminated is known as carve out. Any guideline that has been added while preparing Ind AS is known as carve in. Okay. Now, let's take one quick example of carve in and carve out so that you know what is actually carve. Let me give you an example. Anybody writing along with? Do you want me to wait? Okay, let's go ahead. Long-term arrangement. Long-term loan arrangement. Let's say you have taken a loan. An entity has taken a long-term loan. Long-term loan arrangement. Do you agree it is classified as non-current liability? Correct? Okay, nice. It's a long-term loan, let's say 5-year, 10-year loan, debenture. Do you agree it is recorded as non-current liability? So in both the standards, if we talk about IAS 1 or Ind AS 1, or if we talk about IFRS 18, etc. So both these standards have same saying that whenever there is a long-term loan, please record it as non-current liability. What happens in case if there is a breach of any condition? Breach means non-compliance, any default. Let's say some condition was attached, the entity did not fulfill it. There was a payment date due, but the entity could not pay on that time, etc. Breach means non-compliance, making defaults. In case if there is any breach of any condition, then we have two standards. IFRS 18. Okay, this is a very new standard. Recently, most recently, in the last exam also it was not there. It's a recent amendment, addition, new introduction. It has replaced IAS 1. Earlier we had IAS 1, International Accounting Standard 1. Now it has been abolished and replaced by IFRS 18. IAS 1 has been replaced by IFRS 18. Okay. IAS 1 have been replaced by IFRS 18. It's a brand new introduction. And we have IND AS 1. Okay. Now, as soon as the liability was non-current and now there is a breach, do you agree whenever there is a default and non-compliance, the bank can come and ask for the entire repayment? Let's say if it's a secured loan, then they can come and forfeit the collateral security. Tell me yes or no. If there is a non-current liability on breach, do you agree they can forfeit the amount? They can ask for entire repayment. Correct? Bank can ask for repayment. Correct? Okay, they can forfeit the collateral securities. Okay. So IFRS 18 says that on breach, classify as current liability. Any long-term borrowing after breach, since it is payable now, please record it as current liability. Whereas IND AS 1 also says classify as current liability. Okay. So this is known as no carve. There is no carve till here. There is no difference till here. There are no changes till here. All right. Now what happens if breach is made, if breach is made good, if breach is made good, what happens in case if the non-compliance is now complied? Let's say the entity have not paid, let's say 2 installments. Now they sit with manager and say that do not worry, okay, give me just 7 days grace period, I'll pay it back. Give me just 15 days grace period, I'll pay it back. Do you agree it can happen and the breach can be made good? The non-payments can be paid, the non-compliances can be complied with. So let's say if the breach is made good, then what happens? If the non-compliance is now complied, then what happens? IFRS 18 says that continue to record as current liability. Even after the breach is made good, even after the non-compliance is made good, they say that please continue to record the liability as current liability. All right. Whereas IND AS 1 says, okay, let's be little flexible, let's give little option. All right. Because it can happen if they have made good, then we should trust back the entity, and thereby says that let's give little relaxation, reclassify current liability back as non-current liability. Okay, so this is a change. IFRS 18 is strict, IAS 1 is strict, and says that you cannot re-record and reclassify back to non-current liability. Once there is a breach, there can be multiple breaches expected, and thereby please continue to record the long-term loan as current liability. Do not reclassify it back to non-current liability. Whereas IND AS 1 says that let's give little relaxing options to the company so that they can easily accept international standards, and thereby they say that let's give little flexibility in case if the breach is made good, if the non-compliances are complied with, then reclassify current liability back as non-current liability. Give me a quick thumbs up. This is an example of carve. Carve means change between IFRS and Ind AS. Difference between Ind AS and IFRS. Give me a quick thumbs up. Quickly confirm, are we good? Ravinder, Vijay, Pavan, Manjula, Hafiz.
So I have one
Okay.
small doubt.
Yes, please ask.
So whenever we will classify the long-term liabilities, actually we will split into two, right? So whenever whatever it is due within a year, it should be treated as a short-term current liability, and balance will be the long-term liability. That's non-current liability we will classify it. So whether it will be any difference in this or
Okay, now in this case, let's say it's a 10 lakh rupee loan. 1 lakh is payable in the next 12 months. And let's say remaining 9 lakh is payable after 12 months. All right. So 1 lakh will be classified as current
yes.
and 9 lakh will be classified as non-current. Clear?
Yeah.
Good till here. Basic, very basic. It was same in AS also, accounting standard also.
Correct.
If there is a breach, this entire 10 lakh should be recorded as current liability.
Okay.
Got it?
Okay.
Okay, why? Because we are expecting, since the entity has non-complied, okay, has made a breach, has made a default, this means there are high chances that the bank can ask for entire repayment. All right?
Right.
The amounts can become repayable. So thereby now we cannot wait for entire next 5 or 10 or 20 years. Instead, it can become payable in next like near future. And therefore, entire 10 lakh loan will be recorded as current.
Correct. Okay. Okay, good.
Okay.
Thank you.
Sure. Now, once the breach is made good, after the corrections are made, after the compliances are made, IFRS 18 says that continue to record entire 10 lakh rupees as current liability, whereas India says that if they have complied with, then please reclassify back this 9 lakh as non-current and continue to record 1 lakh as current. Okay. Anybody, any question? Be comfortable. If you have any query, please ask. Okay, Vijay says all right. Anybody, any question? Okay, nice. Now, how the numberings are interconnected, let's look at it. IAS for India, we say, okay, same numbering for Ind AS. Whereas if it is IFRS, then they have said that if we do the same numbering, there will be confusion, and therefore please show 100 plus numbering for Ind AS. Okay, I'll give you example. Let's say if there is IAS 1, then it will be Ind AS 1. If there is IAS 2, then it will be Ind AS 2. All right, same numbering. If it is IAS 3, it will be same numbering, Ind AS 3. But if you talk about IFRS, let's say if it is IFRS 1, and if you write Ind AS 1, do you agree there will be a clash whether it is IAS 1 or IFRS 1? Correct? If we write Ind AS 1 again, do you agree there will be a clash? Because in foreign countries, we have two lists of standards, IAS and IFRS. But in India, we have only one single list of standards known as Ind AS. All right. So if we continue with same numbering, there will be a clash. Ind AS 1 and Ind AS 1, whether it is representing IAS 1 or IFRS 1, there will be a contradiction. So therefore, in order to represent all the IFRS, they say instead of 1, write 100 plus numbering, that is 101. If it is IFRS 2, write Ind AS 102. If there is IFRS, let's say 3, please write Ind AS 103 and so on. You must have heard about Ind AS 115, Ind AS 116, 117. Okay, it does not mean that we have 117 standards, 116 standards. Instead, it is because of the numbering pattern. The total standards applicable are 42 standards. Clear? Everybody all set? All good? Anybody, any doubt? Anybody, any doubt? Now, if you learn anything, okay, now if you learn any standard and if you have to apply Ind AS, then you can easily apply Ind AS. If you learn IFRS, you know Ind AS also simultaneously. Okay. So here we have quickly introduced the IFRS. Why? And because of Enron company, there was a scandal, huge question on reporting, and thereby a separate list of standard was introduced. We have total 42 standards, 24 IS and 18 IFRS. They are together known as IFRS standards. In India, we have converged it from IFRS, but with some little changes which are known as carves. If you add something, it is known as carve in. If you remove something in Ind AS from Ind AS, it is known as carve out. We have taken an example of long-term breach, okay, regarding carve. And now, if you talk about the numbering, for IAS, there is same numbering. For IFRS, there is 100 plus numbering. So that's how we have, I would say, completed the basic introduction of IFRS. Okay. We'll start with our today's first topic. Okay. That is IAS 16. Property, plant, and equipment. Property, plant, and equipment. Okay. Before starting this, do you know about fixed asset standard AS10? Tell me yes or no. Do you know about fixed asset standard AS10? Yes or no? Okay. Okay, we all have applied that. It was there in accounting standard. Any kind of asset, whenever it's a long-term asset, we classified and recorded as per AS10, that is fixed asset. We never questioned it. But now IFRS says that I will provide the presentation more clear, in a more better way. The disclosures will be more detailed, and thereby says that we will question the intention of the asset. Why it is there? What is the intention behind it? What is the purpose behind it? All right. If the asset intention is to use in business, okay, use in business, if the intention, if the purpose is to use in business, then we will classify it as property, plant and equipment and apply IAS 16. In case if it is other than business use, then we will classify it as investment property, IAS 40. Give me a quick thumbs up. Everybody, give me a quick thumbs up. Are we good? Yes, Ravinder Jani, any doubt? Okay, all right. Okay, so the purpose, we will check the purpose behind the asset. If the purpose behind the asset is to use in business, we will classify it as per IAS 16, property, plant and equipment. Okay. In your balance sheet, there will be non-current asset. Under non-current asset, you will have property, plant and equipment. Okay, PPE, property, plant and equipment, and investment property. As separate line item on the face of the balance sheet, you will not club it and show it as one single line item. All right. These will be shown as separate line item. If it is for business purpose, it will be known as property, plant and equipment. If it will be for other than business purpose, we will classify it as investment property. We will show it as separate amounts on the face of the balance sheet. We will not club it. We cannot club it and show it as one single asset. Give me a quick thumbs up. Do you get this? And for investment property, we will apply IAS 40. You cannot club these two figures and show it as one single line item. Instead, you need to split and record the items and show the items as separate line items on the face of the balance sheet. Okay, all right. Hand raise is to ask question. If you have any query, please ask. Anybody? Okay. So let's read the definition part. This entire PPT, PDF, everything will be given to you along with the lecture. Okay, if you want, you can copy down. If you want, you can copy the whiteboard notes. Okay, and refer the PDF for revision purpose. What is property, plant and equipment? What is PPE? Any tangible asset. Tangible asset means any asset which has physical presence, can be touched, can be seen. Example, any machinery. Do you agree it has physical presence? Definitely. So tangible asset which is used in production or supply of goods or service or for rental to others. Let's say your main business is of renting out. Let's say we have Ravinder and Ravinder has a tour and travel agency. Ravinder owns, example, 10 Volvo buses and 20 Innova cars. All right. Let's say Ravinder has a business of tour and travel and owns 10 Volvo buses and 20 Innova cars. All right. Now people come whenever they want, agencies come and whenever they want, they hire, they take the vehicle on rent from Ravinder. Main business activity is to earn rent from those vehicles. All right. Main business activity is to earn rentals from those vehicles. If main business activity is rental and then you're collecting rental, the 10 Volvo buses and 20 Innova cars will be recorded as property, plant and equipment in Ravinder's balance sheet. Give me a quick thumbs up. Does it make sense? Make sense? Your main business activity is to collect rents. All right. On the other hand, let's say Ravinder has a textile business, but he owns one car and let's say one just a pickup truck to transport goods from here and there. Okay, from one place to another. He has a pickup and a car. Let's say the pickup is sent on rent. It is not his main business. The main business is to earn from textile business. The main business activity is textile. Therein, if they are collecting rent, then the asset will not be recorded as property, plant and equipment. If the asset is being used for business purpose and the main business activity, okay, then only it will be recorded as property, plant and equipment. Other than this, administrative purpose. Administrative purpose means head office, headquarters. Let's say head office. Okay, back office, headquarters. Okay, or maybe any office work. Okay, let's say the production process is not being I would say taken up, but admin part is taken up. All right, then do you agree it will also come under property, plant and equipment? Let's say if there is a land and building and it is used for head office, it is used for back office purpose, wherein the admin part is taken care, then that land and building will also be considered as property, plant and equipment. Lastly, it is expected to be more than one period. It is expected to be more than one period. Clear till here? Anybody any doubt in definition? Anybody any doubt in definition? Okay, good, good. Okay. Now, whenever we read any standard, okay, whenever we read any standard, it has its own scope, recognition criteria. Okay, it's, I would say, additions, deletions. Then it has derecognition criteria. What does recognition and derecognition means? There are two terms, recognition and derecognition. As an accountant, how do you recognize any transaction in your books of account? I want you all to answer. As an accountant, if you want to record any transaction, if you want to recognize any transaction, how do you record it in the books of account? How do you recognize? Based on income generation of asset. Okay. What else? See, it can be an expense also. I'm talking about recognition of any transaction. It can be a salary expense. It can be a rent expense. Okay. It can be a purchase of any asset, inventory. How do you recognize any transaction in the books of account? Correct. As an asset, we will recognize only when there is probable economic future benefit. You are expecting multiple years benefit will be derived. You'll record it as asset. We always recognize by passing a journal entry. How do you recognize any transaction in the books? By passing a journal entry. How do you de-recognize? By passing a reversal journal entry. Correct? How do you de-recognize anything? By passing a reversal journal entry. As an accountant, whenever there is a transaction, we will recognize by passing a journal entry. Whenever there is a de-recognition required, we will pass reversal journal entry. Okay, we are clear till here. We get this. Now, each and every standard will tell you when to pass journal entry. Give me a quick thumbs up. Each and every standard will tell you when to pass journal entry. Okay, they will give you some criterias. Okay, if criterias are fulfilled, then you can go ahead and pass a journal entry. Example, property, plant and equipment debit, let's say to bank or to payable. You can pass a journal entry when this criteria is met. What is the criteria for PPE? It says probable. Probable means high chances that there will be some inflow. Probable means high chances, expected, hope to receive future economic benefits, some benefits in the form of cash or kind. In future, it is expected that the owner will receive some benefits either in cash or kind, okay, in future period, and will flow to the entity. Entity is the one who is entitled for the same. And the cost can be easily calculated, can be reliably measured. If both of the criteria are met, okay, this is plus. End means plus. If both of the criteria are met, you can pass journal entry in the books of account. You can pass journal entry in the books of account when both the criteria are met. Clear? Anybody, any doubt? Okay, next. Now, what will be added to cost of the asset and what will not be added to the cost of the asset? And trust me, there are many questions in your mock, in your kit questions, in your ACCA paper, mock paper, that it will test you, it will challenge you. Do you know which costs are added and which costs are not added? Okay, so we'll talk about each and every item one by one. I'll try to explain the reason behind it also. Firstly, starting with purchase price. Purchase price minus trade discount minus rebate. If you get trade discount, what is trade discount? Discount that you're getting on at the time of bulk purchase, and cash discount. If you talk about trade discount, deduct from cost. Deduct from cost. From cost of the asset, it should be deducted. Talking about cash discount, charge in PN. Do not adjust in cost. All right, trade discount will be deducted, will be adjusted, but cash discount will not be adjusted. Okay, I'll tell you the reason why. Trade discount is received at the time when you're purchasing the asset, when you're acquiring the asset. Okay, it is received at the time of purchase of the asset. Whereas cash discount, is not necessary, and secondly, it will be received on the settlement of the transaction. Do you agree that we follow mercantile basis? We don't wait for the entire transaction to settle. We follow mercantile basis. We will record the transaction as and when it has taken place. We will not wait for the cash settlement. Tell me yes or no. Tell me yes or no. Correct. So trade discount will be deducted from cost, but cash discount will be received 1 month, 2 months, 3 months, 5 months later. We cannot go back and adjust the cost and then adjust the depreciation on the same, because it's an asset. We cannot afford to change our financials back again and again, reverse the initial entry, adjust the initial entry. So therefore, trade discounts are allowed, rebates are allowed, but cash discounts are not allowed to be adjusted in the cost of the asset. Instead, charged in P&L. Next, non-refundable tax will be added, import duties will be added. I'll give you a simple example. Let's say there was an asset purchased, let's say of $1,000, just an example, $1,000 or rupees 1,000. Okay, let's say rupees 1,000 or 10,000, whatever. No worries. Now, do you agree whenever you buy something, you have to pay GST? Let's say 12%. You paid 1,200, correct? 10,000 into 12%, 1,200. What is the total outflow? 11,200. Now the question is, will you record asset at asset 10,000 or will you record asset at 11,200? Will you record asset at 10,000 or will you record asset at 11,200? Okay, I want each one of you to try 10,000, 10,000. I've got two answers. What about others? Pavan, Ravinder, Vijay. Okay, both. Pavan says 10,000. Ravinder, any guess? Both. Okay, so I'll tell you, it depends upon whether the buyer entity is registered with GST or not. Example, if you buy a laptop or if I am buying a laptop, if we are not registered in GST, do you agree? The GST amount is the final outflow from our pockets. We don't get any inputs, any set off. Correct? Whereas, let's say, just an example, there is a company which is buying 100 laptops for their employees. Do you agree? If they are registered, they will get input for all the laptops. Okay, makes sense? So, there are two cases. Correct. There are two cases. You have to check if buyer entity will get refund or if buyer entity will not get refund of tax. Refund means set off also is refund of tax. Sorry. If buyer entity will get refund of tax, okay, then buyer entity will record asset of 10,000 and GST input credit of 1,200. Whereas if buyer entity will not get refund, then they will record asset at rupees 11,200. Give me a quick thumbs up. If they will not receive any inputs, any set off, then they will record the asset including GST, including any taxes. It can be foreign taxes, it can be Indian taxes, it can be import duties, it can be any local tax, any VAT, any excise duty. Okay, clear? Anybody, any doubt? In both the cases, your asset side will be debited like this and to bank or to payable, whatever the amount is. Clear? So it depends upon whether the entity is registered or not. Next, borrowing cost. We'll read about borrowing cost in IAS 23. See, right now we are reading IAS 16. Okay, in the next class, we'll read IAS 40. Once we understand IAS 16 and IAS 40, that is property, plant and equipment and investment property, then we will head towards borrowing cost and we'll see when the amount is added to the cost of the asset. Right now, for time being, you can leave this borrowing cost topic. Okay. Next, include directly attributable cost. Include all the directly attributable cost. Till the time the asset is ready for use. As soon as the asset is ready for use, okay, all the expenses incurred, any necessary expenses incurred, add to cost of asset. That is capitalize. Whereas any expenses that are incurred after the asset is ready for use, charge expense in P&L. That is, do not capitalize. Okay. Let me give you some example to understand it better. Let's say you ordered air conditioner. Okay. You placed an order at Amazon.com. Now it will take 2-3 days to deliver. Okay. Now when it got delivered, do you agree there will be some delivery fees? Okay. Then one technician will come in 1 or 2 days, in 24 hours or 48 hours. They will install the split AC. Two components will add extra wires, pipes, fittings, drillings and all extra stand. Then after that installation, okay, they will hand over you the remote. You will put cells and you will check whether it is working or not. We'll take some fresh, I would say, cold air. Okay, check whether the AC is working all right or not, and then only let the technician leave your premise. Tell me yes or no. You ordered an AC, it got delivered, installed. All these expenses were necessary. You checked whether it is working well or not. Then only you would let the technician leave. Okay, delivery, installation, checking, that is testing. Everything was necessary till the time it was ready for use. Let's say you ordered an air conditioner in winter season. Let's say it was your mom and dad's anniversary, or let's say Christmas, and you ordered an air conditioner for your parents. Do you agree they will not on it, they will not use it in the winter season? Maybe 1 month, 2 months, 3 months later, along with mangoes, they will enjoy AC. Let's say along with mangoes, they will enjoy air conditioner, but it has been already installed. Give me a quick thumbs up. Let's say you have surprised them with a AC, but it's winter season, they're not using it. Now the question is, as an accountant, will you start charging depreciation in the month of December itself? Or will you wait for March and April when it is actually being used? Okay. So IFRS says that we will start charging depreciation as soon as the asset is ready for use. Okay. Note, start charging, correct, from December itself. Start charging depreciation as soon as the asset is ready for use. okay, is ready for use. Start charging depreciation as soon as the asset is ready for use. All right, we will not wait for the actual usage. You will find questions, examples, case studies, scenarios wherein they will give you 2 or 3 dates that okay, it was ready for use on this and this date, it started using this and this date. Okay, you do not have to get confused. If they ask about depreciation, start charging as soon as the asset was ready for use. I'll give you another example. Let's say an entity installed fire extinguisher. Now the accountant says, I want to charge depreciation on the same. For charging depreciation, in case if usage is prerequisite, do you agree? The accountant will never be able to charge depreciation. If the owner says that, okay, let's charge depreciation, in order to charge depreciation, we need a fire outbreak. Then only we'll be able to use this fire extinguisher. Will it work? Does it work this way? In order to claim depreciation, they are trying to have a fire outbreak and thereby they will get depreciation on fire extinguisher because they have to use it. Correct? Tell me yes or no. Does it work this way? No. Correct? No. Nobody. Okay, it doesn't work this way, and therefore IFRS says that as soon as the fire extinguisher is ready for use, you are allowed to start charging depreciation in that year itself. You don't have to wait for actual usage. Promise me that whenever actual usage comes, you will not be, I would say, confused. You will not get confused because of that. Okay? Anybody, any doubt? Okay, next. So any directly attributable cost for bringing the asset ready for use condition, that will be added to the cost of the asset. Let's say site preparation. You have imported an asset from a machine from China. Do you agree to, after importing, you need a place to install? Maybe it requires some necessary changes, let's say power, voltage, etc. The same will be prepared, installed, then only you can get the machinery fixed and ready for use. So site preparation is necessary, will be added to the cost of the asset. Initial delivery and handling. The AC, if delivered, will not give you cool air, correct? In order to get a good use, you need to get it installed. So initial delivery, handling, installation, assembly, all these costs are necessary. Professional fees. Example, you are buying a piece of land. Do you agree before buying it for lakhs and lakhs of rupees, you would love to get a second opinion from any educated lawyer and look into it, check before. If the property is not disputed, just confirm that is the property not disputed, then only I want to go ahead with lakhs and lakhs of investment, otherwise not. Okay, will anybody be interested in giving 10, 20, 30, 50,000 to lawyer and asking him to give him a report that whether this property is disputed or not? Can happen. Okay, I'll give you another example. Let's say you are a very good accountant, you're very good with numbers, you're very good with debit and credit, you're very good at multiplying profits. But you don't know, let's say, the engineering part. You don't know from which company you should buy the machinery, of which model you should buy the machinery. Okay, so you require help of some expert engineer who will tell you, okay, if you want to buy this and this, then go for this company and this model and this version and this, okay, whatever the things are. Okay, all right. So you have taken some professional fee, you have paid some professional fees to any engineer, any, let's say, lawyer. Okay, engineer, lawyer. Let's say you are acquiring a hotel chain. Do you agree before acquiring hotel chain, you would love to get a due diligence report from CA or CS and see if there are no hidden contingent liabilities, no hidden losses attached? Tell me yes or no. while buying a hotel chain, will you be not interested in asking and having a due diligence report from a CA and CS and be very fully aware that, okay, is there any hidden charges, contingent liabilities coming along with the company? All right, due diligence. So you have paid to any CA, CS, okay, for due diligence, etc. All right. If for buying any asset, if you are paying any professional fees for that particular thing, it will be added to the cost of the asset. Cost of testing will be added to the cost of the asset. Site restoration. Let me give you an example. Let's say, assume you are a real estate owner. Okay, you have a real estate business. Let's say Manjula has a real estate business. Now, you have got a contract to build a complex or maybe an IT park, okay, for your client. And you're happy? You've got a new contract. Let's say to complete this complex and IT park construction, it will take 3-year time. Let's say Manjula has a real estate business and thereby she has got a new contract to build a IT park, build an IT or maybe a complex. It will take 3 years. Do you agree during this 3-year tenure, there will be lots and lots of machines installed, like let's say cranes, cement machine, building machines. Okay, maybe temporary tents are, I would say, set up in order to accommodate the daily labors. Tell me yes or no. It can happen that there are many machines installed, there are many tents around it installed so as to accommodate the laborers. Do you guys agree that at the end of the project, when Manjula is handing over the complex and IT park, do you agree she is expected to remove all these machines and tents around that complex? Yes or no? Correct. Okay. While handing over, we are expected to clear the site. Okay, let's say there was a factory which was making very much like too pollution, then they are expected to compensate for the pollution. Let's say another example, there was a company which wanted to extract petroleum from earth. Do you agree in order to extract petroleum, they have to install huge drilling machines to extract petroleum from earth? After the extraction work is complete, do you agree they're expected to uninstall those used machines? Clear? So, there are many times at the start of the project, you are expected that when the project ends, you will have to incur certain expense. As an accountant, we follow conservative concept. We follow prudence concept. Any upcoming expenses or losses, let's record it as a provision. Any upcoming expenses, losses, if you know, let's recognize it today itself. Let's create a provision itself. All right. So site restoration, okay, clearing all the machines and temporary tents is site restoration. This is also known as dismantling. Okay, or you can say decommissioning. This is recorded at present value. How to calculate present value? We will look at it later when question comes along. But we have to calculate it at present value and add to the cost of the asset at the initial recognition itself. Because we know this is an expense which will be incurred at the end of the project. Give me a quick thumbs up. Do you get this? Anybody, any doubt? Please confirm. Any question? Any doubt? Okay. We have questions which will target these terminologies: site preparation, initial delivery, installation, professional fees, cost of testing, site restoration. They will give you some figures like this. You should know whether to add or whether not to add. So these are all the costs that will be added while recording any asset in the books of account. Now we have a list which will not be added, not be included in the cost of the asset. Example, opening a new facility, let's say inauguration. Okay, chai samosa party, inauguration expenses. Starting a new product or a service. Okay, at a new location, you're opening a new branch, these expenses will be charged in P&L. They will not be added to the cost of the asset. These all expenses will be charged as an expense in P&L. They will not be added to the cost of the asset. Why? Because asset being ready for use is not dependent upon whether there is a new location or an old location, whether there is a new facility or old facility, whether you have given a huge grand party of opening or not, etc. The asset being ready for use is not dependent on these expenses. General overheads will be charged in P&L. All the asset necessary to bring all the expenses necessary to bring the the asset in a ready for use condition in the location and condition will be added. After this, any costs are there which will not be capitalized, will be charged to P&L. If the asset is being used at a lesser capacity than the full capacity, let's say an asset has a capacity of manufacturing 1 lakh units, but let's say the demand is very low this month. You are not manufacturing 1 lakh units, instead you are only manufacturing 60,000 units. All right. So the extra expenses which are being incurred will be charged in P&L. Initial operating losses. Let's say you have installed a machine. It was having high probability that they will give you future economic benefits. But after installation, it made some losses. These losses will be charged in P&L. Cost of relocating, reorganizing, shifting your AC from one place to another, reorganizing the part of the business, training staff, training / retraining of staff will be charged in P&L. Okay. See, asset is ready for use whether the staff is trained or not. Whether your parents know how to switch on and switch off the AC, irrespective of that, AC is on. Okay, AC is ready for use. Irrespective of whether the staff know how to operate this particular software or a machine, irrespective of that, the machinery and the software are ready for use. Clear? Next, if you train a staff within a month, 1 month, or maybe 3 months, the staff leaves. Now you have to retrain the staff. You have to retrain a new staff. Then again, there will be expenses. Training and retraining expenses will always be charged to P&L. Anybody, any doubt? Any question? Please confirm. Any question? Anybody, any question?
Any spares?
Sorry?
We are adding it. Spares we are purchasing and adding it in our machines.
Okay. Any cloud storage, correct?
Yes, storage or spares. We are see, suppose it's a main in the one product of the machine. There is a one main part. Suppose it's a 1 lakh is a worth of machine value. 50,000 is a spare part value.
Okay.
So then whether we need to capitalize or we have to revenue put it as a P&L.
Okay. Okay. I get your point. Firstly, it depends upon company's policy. IFRS does not bound you to 5,000 or 50,000 or 1 lakh. All right. There can be something very precious for X company, but maybe very of low value for Y company. All right. I'll give you an example. Let's say maybe a laptop for your company might be a big asset, but for data company, let's say Big Fours and all, they buy lakhs and lakhs of laptops altogether. For them, it's a very low value asset. All right. So IFRS does not bound you in the terms of asset and value. Instead, it is left up to the management. It is management's policy if they want to capitalize any expense. Okay. Then generally management keeps a rule that any expense above 5,000 will be capitalized, above 10,000 will be capitalized, above 10% of the original asset will be capitalized. So firstly, it depends upon management's accounting policy. All right. Secondly, talking about spare part having approximately a huge value which is equal to 50%, all right, which is necessary, which is not avoidable, as per law also it was required, then you will capitalize it. If it has different useful life and different rate of depreciation, then it will be split and separate depreciation will be charged. All right.
Okay.
Okay, depends upon management rules and regulations and accounting policy. Secondly, if you see if it's a major one, major repair, major overhaul, major addition, then in that case it will be capitalized and added to the cost of the asset. Okay, later when we'll read about further topics in property, plant and equipment, we have an example wherein there is a huge addition of asset. Okay,
Okay.
so how do you calculate the depreciation? In that case you'll come to.
Okay. Okay. So only small one doubt. Actually,
Sure.
if the life of the asset will increase, then we have to capitalize. Suppose if it is the life of the asset will not increase, then we have to put it as a P&L, right?
Generally we do this. Okay, generally we do this. If life of the asset, if capacity of the asset increases, even if it is maintained, then also we can capitalize. I'll give you an example we have in our book also. Let's say a safety guard was added, which was required as per the law. There is a new change in law. Okay, a new legislation has come up, and because of this, you have to add safety guard. Do you agree safety guard is not increasing life or improving the capacity? Correct?
Yes.
It is just required because of law. Since it's a huge component, it is required as per law. You can capitalize. IFRS allows the capitalization. All right.
Okay.
Okay. Sure. IFRS never says whether it capitalize only if it is increasing life, capitalize only if it is increasing the capacity. IFRS does not restrict that way. It leaves up to the management policy.
Okay.
Sure. Anybody, any other concern, any doubt? Accounting policy can be changed during financial year also. It is covered under IAS 8, change in accounting policy. It can be done if a standard itself says so, or it can be done if the entity proves that changing the accounting policy is providing more reliable and more relevant information. So if they can prove that it is providing more reliable and more relevant information, they can go ahead and change the accounting policy. But consistency is appreciated. Once you adopt any policy, try to consistently apply it. It is encouraged to consistently apply it, not change it again and again, because it then affects the comparability. In order to keep all the financials very comparable, they should stick to the same line of accounting policy. All right, but they can change. They are allowed.
Here point
Okay.
6 is discussing about after the ready to use asset or before point 6.
Point 6. Cost incurred when an item capable of operating has not yet been brought into use. Let's say it is not yet put to use. Let's say you have an asset, it's lying idle, it is not yet put to use. So there is a question, okay, whether to capitalize the extra cost or not. So we are saying that do not capitalize as soon as the asset is ready for use. Even if it is not being utilized or half utilized, still don't charge any extra expenses to the cost of the asset, instead charge in P&L.
Okay, that being used at less than full capacity is also like ready for use, after the ready for use, right?
Correct. Yes. Okay, it is installed, it is ready for use, but they are not using it. Okay.
Okay.
Ravinder, got your answer? Yes, the accounting policy can be changed during the year. It is appreciated not to change, but it is allowed. It can change. Okay, nice.
Yeah,
Let's
one
try
more
an
thing.
example.
If there is
Please go
a
ahead.
machine purchased and kept somewhere, and for that entity is paying rent,
Okay.
then rent when we have to book.
Ravinder, repeat please.
If I purchase a machine, but it
Okay.
is not in ready to use due to some
Okay.
other reason, But for that some speculated time I have to kept in some property. I have to rent some property, and
Okay.
I'm keeping that machinery at that in property. So I'm
Okay.
paying that I'm paying rent.
Okay.
Okay, then where I have to book this rent?
Okay. The rent expense is necessary and it is incurred before it is ready for use. All right. In this case, it will be capitalized. It will be added to the cost of the asset because it is a necessary cost in order to bring the asset in a ready for use condition. Okay. It will be added to the cost of the asset.
Okay, noted.
Okay. Sure. Okay. Let's try a very simple example. There is an asset brought and there are three methods given: SLM, WDV. We all know about this. Anybody who does not know about it? Machine hour, there can be production unit. IFRS is very flexible. It gives many choices to the entities. All right, they can use SLM, they can use WDV, they can use machine hour method, production unit method, etc. A lorry bought for Titan Company costs $17,000. It is expected to last for 3 years and then be sold for a scrap value, for a residual value 2,000. Usage is given over 3 years, is expected to be 150, 100 and 50. This means 300 days. All right, 300 days. So cost minus residual value divided by total useful life will give you, total useful life will give you per annum depreciation. Can you calculate SLM depreciation? Can you calculate per annum depreciation? Tell me yes or no. How much? 5,000 per annum. Correct. 17,000 minus 2,000 divided by 3 years. Okay, correct. So thereby you will get 5,000 per annum. All right. WDV method in the year 1, year 2 and year 3. 17,000 into 50% rate, that is 8,500. What is the remaining value? 17,000 minus 8,500, 8,500 into 50%. Pawan, what is the amount?
4,250.
4,250. Okay, 4,250. All right. Then into 50%, how much? Vijay, Manjula? 2125, correct. Okay.
No, but the asset is only for 3 years, right? Why you are doing year 3.5 again?
Because it's a 50% rate for WDV method. Depreciation, the WDV never goes zero. Do you know this? That when we are following WDV method, the value never becomes zero.
Okay.
Okay, the depreciation keeps on going. Now, when the asset will be disposed of, will be sold off, will be de-recognized, at that point in time, whatever the amount is, that will be removed. Whatever the inflow is, that will be recorded, and the difference amount will be treated as gain or loss. Yeah?
Understood.
Okay, nice. Next, machine hour method. Let's calculate per day depreciation. Per day depreciation equals to 17,000 minus 2,000 divided by total number of days, that is 300 days. Tell me the per day depreciation. Depreciation per day equals to How much? 50 per day, correct? 50 per day is your depreciation. So can you calculate for each and every year? 50 into 150 will be, you will get year 1 depreciation 50 into 100, year 2 depreciation 50 into 50, year 3 depreciation. Okay? Anybody, any question, any doubt? Anybody, any question, any doubt? Okay, nice, nice. Then let's go ahead with P&L. Okay? We have statement of P&L and OCI. Statement of P&L and OCI, other comprehensive income. We have two separate heads, P&L and other comprehensive income, profit or loss and other comprehensive income. Okay, and other comprehensive income, this is known as OCI. Under P&L you have revenue, cost of sale, gross profit. Then we have, let's say, incomes, expenses. Okay, you will have operating profits. Then after operating profits, you will deduct finance expense. Then after finance expense, you will have profit before tax. After profit before tax, you will have tax expense. Then we will have profit after tax, correct? Whatever the profit after tax is. Then under OCI, you will have incomes, expenses, all right? Whatever the amount is will be added. Now, P&L and other comprehensive income total is known as total comprehensive income. Which is in short known as TCI. P&L, that is profit after tax plus other comprehensive income, together are known as total comprehensive income. Give me a quick thumbs up. Profit after tax plus other comprehensive income is together known as total comprehensive income. Profit after tax plus other comprehensive income is together known as total comprehensive income. Now, as an accountant, we were very happy, comfortable with P&L. We used to charge all our incomes, all our expenses in P&L. Then why do we have OCI? You must be having question. Why do we have OCI? And second question, if we have OCI, when do you charge any income expense under OCI? Okay, do you have these two questions? That why do we have OCI? And when do you charge any income, any expense under OCI? You guys have question like this? Yes or no? Be quick. Okay, good, good. Okay, why OCI? We were very happy, very comfortable with P&L. We were charging all our incomes and expenses under P&L. Happy. All good, all set. Why we have introduced, why IFRS has introduced OCI? Okay, I'll give you one reason. Earlier, before the introduction of IFRS, we were not having fair values, revaluations and all. But after the introduction of IFRS, we have multiple places, multiple standards asking to fair value the asset and liability again and again. Do you agree these fair values are not real gains? Let me give an example. If you have a share, any equity share, mutual fund, maybe a land, the value increases. Do you agree the income tax department does not charge you any taxes till the time the gains are not realized, till the time the gains are not actually realized, the sale has not taken place? Sita Ramanji comes only when Sita Ramanji is our finance minister. She comes only when you actually sell and actually get a capital gain. Correct? Tell me yes or no. Do you agree? Give me a quick thumbs up. Be quick. Do you agree Sita Ramanji comes and asks for taxes only and only when we actually sell it? Clear? Other than this, those are notional gains. Let's say you have a house of 10 lakh rupees. Now you're living in that house. Okay. Let's say suddenly you come to know that this house value has increased from 10 lakh, it has become of 50 lakhs. Let's say the property values have gone high. The value of this asset has become 4x, 5x. Do you agree you still do not have any intention to sell? It's your home, you want to live in this home, irrespective of the value. The value hike is only notional, those are not real gains. Give me a quick thumbs up. Everybody, quickly confirm, do you get this? The value of property, asset might increase in books, might increase for papers, might sound good in values, numbers and figures might be attractive, but no intention to actually realize it. Those are known as notional. So all these fair valuations are done just for notional purpose. These are not actual gains and all. Therefore, if you keep charging all the notional gains and losses in P&L, do you agree your P&L will not show the right figures? So in order to protect your P&L, in order to make sure that the P&L shows only the actual incomes and expenses, they are not being disturbed because of some notional fair valuation. They have introduced, IFRS has introduced a separate concept, a separate, I would say, section known as other comprehensive income. Give me a quick thumbs up. जल्दी से confirm करेंगे, quickly confirm. Got it? To protect P&L, to not show any unnecessary incomes and expenses in P&L, we have other comprehensive income. This is the very basic idea of it. Now, second answer. When do you charge any income, any expense in OCI? Only and only when a specific standard specifically tells you that, okay, accountant, please charge this income under OCI. Then only you will charge under OCI, otherwise not. In a way, as a conclusion, I would say, as an accountant, you will charge all the incomes, all the expenses, always in P&L, unless a specific standard states otherwise. Okay, give me a quick thumbs up. Is it clear? Please confirm. When will you charge any income, any expense under OCI? Only when a specific standard in particular states the same. Okay, good. So why do we have OCI? Why do we have OCI? OCI is to protect P&L. OCI is to protect P&L. Notional gains should be charged under OCI. Equity related adjustments to be charged under OCI. Now, equity related, I have many examples, but they are related to complex standards like IAS 19, employee benefit and all. So right now, it does not make sense to understand equity related adjustment. Just understand, those are not regular things. Those are just out of the owner capacity. Anything done in owner capacity will affect OCI. Okay, to protect OCI P&L, the notional gain should be charged under OCI only and only when OCI says the same, only and only when a specific standard states the same. Okay, next, revaluation accounting. accounting for revaluation model. Firstly, for a company, it's a choice whether they want to go ahead with cost model or revaluation model. Now, do you agree whenever they will follow fair value model, or you can say revaluation model, one and the same thing? Whenever they will follow fair value model or revaluation model, do you agree that there can be three situations? Either fair value will be more, equal, or less. Either the fair value will be more, equal, or less. Correct? So there is a terminology known as book value. What is book value? What is carrying amount? Book value and carrying amount are one and the same thing. Book value and carrying amount are one and the same thing. These are the amount at which an item, an asset or liability, an item is recorded in books. Let's say you have a property, plant and equipment of 1 lakh rupees. Then 1 lakh rupees is the book value, carrying amount. Let's say you have, just an example, inventory of 20,000 rupees. Then 20,000 rupees is your book value. Give me a quick thumbs up. Book value and carrying amount are one and the same thing. These are the amount at which any particular item is recorded in the books. Okay, these are the item at which any amount. These are the amount at which any item is recorded in the books. Whenever there is fair value, let's say book value is, just an example, book value is equal to rupees 1,000. Just an example, or $1,000. This is known as book value for short, and this can be termed as carrying amount for short. Now there will be three situations. Either fair value will be more than book value, or fair value will be less than book value, or fair value will be equal to book value. If the values are equal, no need to adjust, ignore completely. If there is upward valuation or downward valuation. Upward valuation or downward valuation. If there is upward valuation, let's say example, fair value instead of $1,000, let's say it is instead of 1,000 rupees, let's say it is 1,150 rupees. Okay. Example, downward fair value is, let's say, rupees 800. Just an example. We are saying that gain on fair valuation, gain on revaluation will be charged under OCI. Gain on fair valuation will be shown under OCI, other comprehensive income. Loss on fair valuation will be charged in P&L. Okay, let's try a journal entry to make sure that we know exactly. So, upward valuation, your asset will increase, property, plant and equipment debit to gain on fair valuation. Okay, how much? Difference amount, 150 and 150. Whereas your loss on fair valuation, your asset amount will decrease, your asset value will decrease. Asset has a debit balance, it will be credited. So to property, plant and equipment, that is 200 rupees or $200, whatever it is, 200 rupees. Debit, what will be debited? Loss on fair valuation will be debited, rupees 200. Okay, good. Anybody any doubt? Confirm. Anybody any doubt? Gain on fair valuation will be charged under OCI. Loss on fair valuation will be charged under P&L. Anybody any doubt? Okay, see, you have a machinery which is being used for business purpose, and therefore you have classified it as property, plant and equipment. You have a machine which is being used for business purpose, and therefore you have classified it as property, plant and equipment. Now suddenly if you come to know the market value has become 10x, 20x, 30x, the value of the machine has increased, still you have no intention to sell it. Instead you have intention to run your business, continue your business and earn economic benefits from the use of the machine and not from the disposal of the machine. All right. So these gains are just book gains. These are just notional gains. These have nothing to do with actuals, and therefore you will charge in OCI. Now these losses are also notional losses, but we are accountants. And we have a tendency to record all the expenses as provision in the P&L, and thereby this loss is charged in P&L. Anybody any doubt? Please confirm. Anybody any doubt? Anybody any doubt? Okay, nice. Good, good. Okay. Next, subsequent revaluation. Last question, last topic for today, then we'll wind up and we'll cover the remaining part tomorrow. Okay. I hope I'm not boring you. Please confirm. All right, all good. Are you getting it? Are you finding it interesting? Okay, nice. Okay. Subsequent revaluation. See, firstly, it's a choice with the company. They can go ahead with cost model or fair value model. As soon as they apply fair value model, then they cannot go back to cost model. Let's say there is an entity who is applying cost model in year 1, cost model in year 2, cost model in year 3, fine. In year 4, they applied fair value. Now from year 4 onwards, they have to apply for fair value. They cannot come back and apply cost model. Switching from cost model to fair value model is optional. Okay, it's allowed. But switching back from fair value to cost model is not allowed. Okay, so in subsequent year, in first year and upcoming year, subsequent revaluation. Okay, again in subsequent revaluation, there can be two circumstances: upward valuation or downward valuation. All right. In subsequent revaluation, there can be two circumstances: upward valuation and downward valuation. Okay, fine. Now, in upward valuation, we cannot record it as it is. Instead, first check, was there any loss recorded earlier in the P&L? If yes, in the previous years, then please reverse it off first, and then extra gain will be charged to OCI. First, reverse loss on fair valuation in P&L, if any, in previous years. If any loss on fair valuation was charged in previous years in P&L, please reverse that off. After that, okay, afterwards, remaining gain will be charged to OCI, if any. In case if you have any excess gain left after reversal of P&L, then you will charge to OCI. Okay. Similarly, downward valuation. If there is downward valuation, you will not straight away charge in P&L. Instead, you will check First, check and reverse gain on fair valuation in OCI, if any, in previous year. If any in previous year. Second, afterwards, remaining loss will be charged to P&L. Okay. In subsequent years, you cannot go directly if it's a gain charged to OCI and loss charged to P&L. Instead, you will check, was there any gain or loss in previous years? If there was any opposite direction, that means it's a gain this time, but it was a loss previous year, please make sure you reverse all those losses first. And if there is any extra gain, then you charge to OCI these surplus gains. If there was a loss, okay, if there is a loss in the current year, please reverse previous gains from OCI and then charge extra losses to P&L. Let's understand this with the help of example. Very simple examples have been added. Once you try them, a simple journal entry, you'll get to know this. Let's try this question. Okay. First, year 1 and year 2. In year 1, there is an upward valuation. In year 2, there is a downward valuation. I want you all to pass journal entry for year 1. I want each one of you to quickly tell me in the chat box and, okay, let me know the journal entry for year 1. In year 1, there is an upward valuation of $600. If you want, you can unmute and speak up. Otherwise, you can write in the chat box. Both ways, it is fine.
Here, asset account data to valuation, gain and valuation, fair valuation.
Okay. Gain on fair valuation. Gain on fair valuation will be shown where?
OCA.
OCI. Okay. Okay. So, property, plant and equipment debit, asset account debit to gain on fair valuation on revaluation. How much? $600. All right. $600. All right. And you're saying that this gain on fair valuation should be charged under OCI. Okay. Next. In year 2,
Here to loss on fair value 600 and loss on fair value 300, 350 to
okay,
PPE.
to
So first
PP.
600
Okay.
we have to adjust in OCA
Okay,
and balance
nice.
350 we have to charge into P&L.
Good, 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 good. Okay, so there is a downward valuation. So we will decrease asset to property, plant and equipment by $950. All right, there is a downward valuation. You will decrease your value of asset. Now, since it's a loss, you cannot charge entire loss in P&L itself in the first go. Instead, you will charge loss on fair valuation debit, loss on fair valuation debit. All right, $600 and remaining $350. We are saying that firstly, we will reverse the previous gains, those were charged under OCI from OCI. Earlier, OCI was credited in the previous year. Now we are debiting in current year. Then next, remaining loss will be charged to P&L. Remaining excess loss will be charged to P&L. Please confirm, are we good? Do you get this? Hafiz, Manjula, Hafiz good. Manjula, Pavan, Ravinder. Do you get this? That we will not charge this entire loss directly in P&L. Instead, we will reverse the OCI gains first and then the excess will be charged to P&L. Okay. Just last point. Do you know in our balance sheet, in our statement of financial position, we have equity. Equity is a very broad term. It has equity share capital. All right. It has share premium. It has retained earnings. It has revaluation surplus. All right. Equity is a broad term which has equity share capital, share premium, retained earning, revaluation surplus, etc. Now, tell me yes or no. Do you agree that if the company is running from last 10, 20 years, if the company is running business from last 10, 20 years, they must have earned some incomes and expenses. They must have earned some profits and losses during these 10, 20 years of tenure. All these figures are cumulated and shown under retained earning. Do you agree? Tell me yes or no. Cumulative P&L. Till date P&L balances are shown in this. Correct? Till date P&L balances are shown under retained earning. Whatever. Let's say in 10 years there were profit and in 2 years there were losses. They would add those, net it off and show it in the retained earning. If there are profits, retained earning increases. If there are losses, retained earning decreases. Similarly, revaluation surplus shows the cumulative amount of OCI of other comprehensive income. Till date, whatever has been adjusted in OCI, if OCI have been increased, your revaluation surplus will increase. If your OCI has decreased, then your revaluation surplus will decrease. Give me a quick thumbs up. Got it? Does it make sense? The P&L balances are shown in retained earnings, very good, and the OCI balances are shown under revaluation surplus. Manjula said the journal entry, property, plant and equipment debit to revaluation reserve, to revaluation surplus. That is also correct. It's like another term used for OCI. OCI and revaluation surplus can be interchangeably used. It's not wrong. In other words, I would say OCI, other comprehensive income, is a P&L terminology, whereas revaluation surplus is a balance sheet terminology. Give me again a quick thumbs up. Do you get this? Please confirm. Do you get this? Okay, OCI is P&L item, P&L term, whereas revaluation surplus is balance sheet term. So even if you say property, plant and equipment debit to revaluation surplus, it's one and the same thing. Either gain on fair valuation charging to OCI or revaluation surplus showing in under OCI, both are one and the same thing. In case if you come across a journal entry like this with a revaluation surplus, please do not worry about it. Please do not get confused. All right. Ahead of this, afterwards, we'll read about revaluation and the depreciation on the same. What happens in case of complex asset? We have some examples in it. Okay. So we'll cover IAS 16 first in the next session, and then we'll go ahead with IAS 40. Then also we will discuss what happens if there is change in use. Let's say a company was using it for business purpose, now it is using for investment. Or let's say a company had an investment property and now they want to introduce it as a capital in the business. If there is change in use, how do you handle the change? Okay, we'll discuss that in next lecture. All right, everybody give me a quick thumbs up. How was the lecture? Please unmute and go one by one. How was the lecture? Any adjustment, any improvement, anything you want? Please let me know from the first and second lecture itself so that I could apply in upcoming lectures. Please unmute and speak up. How was the lecture?
Swati, it's not very good. Actually,
Okay.
one thing, the PDF will be shared before, then we can also get it print out so that
Okay.
it will be easy for us to underline, or wherever it is required, we can mark it out.
Okay. Okay. So I can share the PDF before also. Okay.
So
Okay.
one more
Okay,
thing, whether
Pawan, all
we
right.
need to purchase any other books
See,
or
purchasing book is not required because
okay.
the books are very costly. Actually, it is of 7,000-8,000 approximately. If you purchase it, it is available on Amazon also. Have you registered with ACCA?
Not that I have to go.
Not registered with ACCA. All right. So if you have not registered with ACCA, once you register, you get access to the entire content. ACCA provides entire content. Other than this, there are two publications, BPP and Kaplan. So we will follow BPP. I'll give you the soft copy. I'll give you my notes also. So it's more than enough actually. But if you still wish to have a physical copy, please let me know. I'll share the link and you may place an order for the same. Okay?
Okay, fine.
Okay? Fine. Sure, sure. Okay, Pawan. Okay, all right. You are in office and still attending. So good. You were also attentive during the session. So really appreciative. Manjula, anything from your side?
Nothing. Actually, I'm attending with our leave their opportunity.
Sorry, please come again.
You have another opportunity to attend the classes.
Correct.
It's very good actually. I'm preparing for the December exam.
Okay. Nice. Good.
Thank you so much.
So be consistent. I just
Yeah,
advise
sure.
be consistent. Okay.
Mm.
Do not
Sure,
pile
sure.
your lectures instead. Even this time you have alternate days in gap. So you can
Yes,
even pick
we
up those
can
lectures
revise.
again. Correct? I'll
Yeah.
also share right now. There are no more questions because we have just read a part of a standard. But later we will have many questions around those topics. Okay. So I'll definitely be adding in my PDF itself. So please revise it twice or thrice. So that's how clearing exam will be very simple. Okay. I'll quickly give you the paper pattern.
Okay.
Okay. It's a 100-mark paper. How do you get 100 marks? There are 4 questions and each question is of 25 marks. Okay, 4 questions. Each question is of 25 marks. It's a completely online exam, computer based exam. It is known as CBE, computer based exam. It is completely online. You get 2 options, center and remote. Center location and remote location. It's completely your choice. Either you can choose a nearby center and visit and write your exam through the laptops given, through the computers given by the center. Other than this, you can book an exam through a remote location and write your paper through using your own laptop and PC. All right. So both ways it will be completely online. If you choose a center location, you are given access to extra blank paper and pen. So in case if you want to scribble around anything, any rougher, you can use that pen and paper. But in remote exam, you're sitting alone in front of camera. There are chances of cheating, and thereby to avoid and reduce that, ACCA does not allow you to sit with any extra pen and paper in remote exam. All right. In both the cases, you are allowed with a regular calculator. You can use calculator in both the exams. Okay, it's a completely online exam, 100-mark paper, 3 hours are given, 180 minutes plus 10 to 15 minutes for reading, 15 minutes for reading instructions. You will not be given access to the questions. Instead, only instructions can be read in that time. All right, so I don't count this 15 minutes. Instead, we only have 180 minutes. So approximately you have to practice as a target to solve each question, 4 questions, 45 minutes each or 40 minutes each. All right, this should be your target in exam. It's a completely subjective question, no MCQs. Full subjective. Okay, full subjective answers paper. All right, you have to provide proper formats, proper working notes, proper explanation, okay, in order to score. It's not an MCQ paper. No negative marking. No negative marking, and thereby quickly write in the chat box that I promise to attempt 100% paper. Right? Promise. Attempt 100% of paper. Do not leave any question unattempted. Why? Because there is no negative marking. You're not losing mark. Instead, the more you attempt questions, it increases your chances of scoring high. All right? And it increases your score because examiner has somewhere to give score. If you leave it blank, then the examiner does not have scope to mark you. All right? So no negative marking, and therefore we all will attempt 100% of the paper. Okay, clear? Anybody, any doubt, any question? 50% is required to pass exam. 50% is required to clear exam. The same will be done in computer-based exam portal given by ACCA. So once we complete at least half of the syllabus, I'll show how the platform appears, how the questions are there, and how you have to write the answer in the computer portal in order to score. Okay, so same will be explained, and you will get complete guidance on how to write the paper. Okay, in your main exams. So it's not of a concern. Anything from your side? Anybody? No, nothing. All set? All good? Hafiz, anything?
Nothing from my side.
Nothing. All good? All set? Did you like
Yeah.
it?
Yeah.
Okay, okay.
Actually, the main thing will come in next further standards.
Correct. In consolidation and all, correct? But
Yeah,
don't
yeah.
worry, I'll explain it in a very simpler way. Okay, we'll take some simpler questions to understand the core of it. And
Yeah.
I'll give you reasons for each and every transaction, why we are adding something and why we are deducting something. All right. So I think once the foundation gets clear, it's easier to handle consolidation.
Yeah, sure.
Okay, don't worry there.
Yeah, thank you.
Sure. Vijay, anything else?
No, good.
Okay. So let's end today's session. Thank you so much for joining. I hope you had fun. I hope you had little knowledge out of it. Okay, just be consistent. See you inside the next lecture.
Thank you
Okay.
for
Thank you.
break your start. Thank you.
Okay. Thank you. Bye bye. Take care.
Bye.
Bye. Take care. Thank you. Okay. Bye. Take care.